We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jesse Felder, founder, editor, and publisher of the FelderReport.com. How are you today, Jesse?
Good, Tom. How you doing?
I'm excellent. Great to finally get to speak with you here. So I was thinking we could kind of start by, getting a sense of how overvalued and where you think we are in the general stock market at this point. And maybe we could do that without, let's say, layering on the Fed policy that obviously is on everybody's mind here. So, looking at the landscape of the mainstream stock market here, how overvalued or undervalued do you think it is?
Well, I mean, that's a really good question. There's all different ways to try and approach valuation of the broad stock market. To me, the most effective way to do that is a way that Warren Buffett introduced us to back in around 2000, 2001, where he basically just took the total value of the US stock market, compared it to the total size of the economy, otherwise known as market cap to GDP. Some people call it the Buffett yardstick. And that kind of gives you a good idea of kind of where you stand in terms of historical valuation of the stock market. Today, we are, and this is interesting, to look at, because Buffett wrote about this in 2000, 2001, kind of around the peak and the early bursting of the dot-com bubble, because he was trying to demonstrate that the stock market had become very obviously overvalued at that time. Today, market cap to GDP shows the stock market to be about 30 to 40% more highly valued than it was in 2000 when Buffett introduced this metric. Mm-hmm. So you could argue that the stock market could fall 30% from its recent peak just to get back to that peak that we saw 20 years ago at the peak of the dot-com mania. So the stock market is more highly valued relative to the economy than it's ever before. Now, some people would argue, a lot of economists would say probably, well, profit margins are a lot higher too. And that's more of a price to sales metric that doesn't factor in profit margins. But my counter to that would be, if you believe profit margins are going to remain at their highest levels in history, then maybe you don't need to worry too much about valuations. But if you think profit margins are going to revert to their some sort of historical mean, then the stock market has never been more overvalued than it is today. And the one thing I would point to that would, potentially revert profit margins, the biggest driver behind profit margins has been the labor share of income. Right? Corporations have grown their share, that's profit margins, and labor has taken a smaller and smaller share of corporate profits for a long period of time. And Buffett even talked about this 20 years ago. He said the only way you could imagine profits staying that high for so long is it would eventually create political problems where labor would say, wait a second, we're not happy taking less and less of the pie. And I think that's exactly the political problems, the rise of populism, things that we've seen in recent years is labor is to a certain extent revolting against this, these high profit margins. And we're seeing it now with wages, the employment cost index we saw last week rose dramatically. Wages and employment costs are starting to rise, and that is a huge threat to profit margins. And if profit margins start coming down, it's going to become more obvious to investors just how overvalued the stock market is today.
Mm-hmm. So what about some other indicators that I've heard you talk about before, Jesse? Something like the Hindenberg Omen, or even something as simple as insider buying or selling. Could you explain what you're seeing when you look at those indicators as well, please?
Yeah, so those things would be more on the side of things that I would use for timing, right? Fundamentals are really good in understanding what are my returns, my long run returns going to be? What can I expect to generate from the stock market over a 10-year period? But fundamentals as valuations don't really help you in understanding, okay, what's the stock market probably going to do over the next 12 months, 24 months? And the Hindenberg Omen is something that was introduced by Jim Mieka a long time ago, several decades ago, I think, in a way to try and identify a coming stock market crash. Essentially, a Hindenberg Omen is triggered when you have a bunch of stocks hitting a new 52-week high. The stock market is very close or at a new 52-week high. But you also have a number of stocks, a high number of stocks hitting new 52-week lows. And so it's essentially a breath warning that when the market is healthy and rising in an uptrend and hitting new highs, you shouldn't see a lot of stocks hitting new lows. When you do, that's a sign that there's dispersion under the surface, where there are not as many stocks pushing the index higher as there probably should be. So I've looked at this indicator and found that one Hindenberg Omen isn't very valuable in kind of indicating even any kind of market weakness. But when you see a number of these signals triggered within a certain look back window, and I use a 12-month period typically. When you see a lot of these signals triggered, it's typically a good sign that breadth is really deteriorating in the stock market and the uptrend is vulnerable to reversing. And so we saw, I think in the last 12 months, we saw maybe a dozen Hindenberg Omens triggered on the NASDAQ. And that was the result of the NASDAQ continuing to power higher, largely as a result of the FANG stocks or the big five. We had a lot of these SPACs and really popular meme stocks, the stay-at-home stocks. A lot of those started plunging last year and making new 52-week lows, and that was a sign that breadth was really starting to deteriorate on the NASDAQ late last year. And I think that was a good leading indicator to the weakness we've seen so far this year. So, that's a breadth warning. It was interesting to me too, when you look at insider selling and insider buying, that the insider selling at a lot of these NASDAQ stocks was the highest we've ever seen, right? So while these big FANG stocks were holding up relatively well, we saw Jeff Bezos unload a ton of stock. Elon Musk sold stock for the first time. We saw Mark Zuckerberg was literally selling Meta or Facebook stock every day last year. So when you quantify this and you look at it as a sell to buy ratio, which I think is kind of maybe the most helpful way to do this, that ratio is really highly correlated to stock market returns about a year out and economic performance about a year out. So when you have a huge sell to buy ratio, lots of selling relative to buying, stock market returns a year later are usually really weak, and economic activity is usually weaker than expected too. So at the same time you saw these breadth warnings, you had huge insider selling, and the ratio went to the highest level in at least a decade. So to me, that was all pointing to the smartest of the smart money, top executives at all these companies saying, now is a good time to sell, because the fundamentals are not going to be so great over the next 12 months. And prices are probably elevated. So when you put all these things together, it kind of gives you an idea of, hey, the stock market is really highly valued. And then, as a long-term indicator, and then the short run, breadth is deteriorating and insiders are using the high prices to offload their stakes. It's it's a pretty clear message as to what, investors should be relatively cautious approaching the stock market at present.
Mm-hmm. So as you say, there's really from a fundamental perspective and a timing perspective, it seems like there's a lot of warnings here. And then if we layer in on top of that, the coming Fed tightening and probable rate hikes this year, does that cause you to view a major correction as even more likely than it already would have been? Well,
I think you can't discuss any of this stuff without discussing Fed policy, right? The only reason we saw the stock market rip higher, from the depths of the pandemic to, more than double in value in less than 2 years was the Fed printed $5 trillion in less than 2 years and literally put that money directly into the asset markets, muni bonds and treasuries, and whatnot. But they also put a backstop essentially behind the corporate debt markets too, in terms of, their verbal guidance. So for as long as central banking has been around, central bankers have understood their ability to stoke what they call animal spirits, essentially risk-taking. They know if we print enough money and put it out there into circulation, we can get investors to seek more risk. And so I think we saw animal spirits. My friend Adam Taggart put it, I was talking to him about animal spirits, and he said, the Fed pumped so much money into the markets, they literally gave animal spirits rabies. And I think that's probably a good way to think about it, that they literally drove investors crazy with risk seeking. And we saw it in all the meme stocks and, GameStop, AMC, and, Tesla call options. Almost $1 trillion of Tesla call options were bought last year, just in Tesla. So the amount of risk taking we saw was just off the charts, incredible. It's bigger than Charlie Munger said, it was bigger than the dot-com mania. I agree. I think anybody who was trading through that period saw this recent episode as something on a different scale. And so now that the Fed is saying we are going to raise interest rates, we're going to reverse this extreme monetary accommodation. We're going to, essentially stop all this money printing and then reverse it, potentially even sell off some of the treasuries. That's a huge reversal in liquidity. And to me, it represents a clear intention on the part of the Fed to rein in animal spirits. And so this is, I think, something probably investors underappreciate right now, that how much of the gains over the last 2 years were created by monetary policy, extreme monetary policy. So how much risk is there now involved? And I think without the support of the Fed, without money printing, there is a real risk of a major bear market in the stock market.
Jesse, you mentioned that investors aren't really pricing that risk in at this point. Why do you think that is? Do you think it's just because they've become so used to this monetary environment that the Fed has created?
Yeah, the Fed has, since Alan Greenspan in the 1987 crash, he really created this idea of a Fed put, which is really trained investors for more than 30 years now, that if the stock market goes down far enough, we will ride to the rescue. We will protect you from experiencing losses in the stock market. And so I think when you train people, you train investors that way for years and years and years, and it was reinforced by Ben Bernanke and most recently Jay Powell in his late 2018, the famous Powell pivot, where he, the Fed funds rate was 2%, 2.5%, something, and he said we're a long way from neutral, essentially communicating to markets, we're going to keep raising interest rates come hell or high water, no matter what the markets do. Mm-hmm. Markets go, oh shoot, down 20%. Powell goes, okay, sorry, no more interest rate hikes. That triggered the Fed put. And so markets go down 20%. Here's the Fed put. Same thing with the COVID crash. Markets go down 30% this time. And Jay Powell says, boom, we're going to print $5 trillion. I think a lot of people, look at, in fact, Jay Powell comes from the private equity world. He understands how important it is to protect, especially the corporate debt markets. That if corporate debt, spreads start to rise to a certain degree, and it becomes difficult for corporations to refinance that debt, we could have a Great Depression type scenario. And so he, no matter what, will ride to the rescue if spreads and corporate credit starts to show enough distress. And I think that's what investors are looking at and saying, hey, we don't need to worry about too much about risk. The Fed put might have been repriced lower, but it's still there. There's no way Powell's going to let the markets completely crash and take the economy down with it.
Mm-hmm. So, Jesse, once we see this real waterfall start to happen, do you think that it'll be quick and sharp, or more long and drawn out? 2 to 3% per week, 5% per week. Do you have a feeling on how that is going to progress?
Yeah, I have a guess. I think it's impossible to say, of course, but to me, this environment is most reminiscent of that bust of the dot-com bubble. And that was really, you saw major crash in some of the highest beta, internet type names, down 90% plus during the course of that bear market and in a short period of time. We're seeing that today. Look at, the price of Peloton, look at the ARK Innovation Fund. These things are just literally in free fall. And, a lot of the stocks, that behind that, portfolio are really good. I think they're kind of that fund is really the poster child of this boom and that we've seen. And so, I think people watch it as a yardstick for what's going on in the markets. But I think at the same time, you have sectors in the market that are totally undervalued. And this is what reminds me of 2000, that all the old economy, right? New economy stocks in the late 90s were, all the software and internet and all those things did phenomenally well. And investors ignored old economy companies or bricks and mortar companies, essentially retailers and banks and all those kinds of things. And a lot of those stocks, commodities-based businesses, became really, really cheap in 2000. And so when you saw the NASDAQ bust, money rotated into those other cheaper sectors. And so there was the broad market didn't really crash like it did in 2008. It was more of a rotation. Mm-hmm. And I think that's probably what we're seeing today is we're seeing some of the craziest sectors inside the stock market. A lot of these SPACs and things are really just in crash mode. But at the same time, you're seeing like energy has been a phenomenal place to invest over the last year and a half, traditional energy. And it was because it just became so cheap and so out of favor and so off people's radar. And I think there's still areas of the stock market that are like that. We'll probably see more of a rotation. So the broad stock market, S&P 500, I do think it will probably see a bear market, but it won't be the type of crash that you maybe saw in the last, in 2008 type of episode. I just don't see like the financial crisis type of episode to precipitate that toward side of a decline. It's a total guess on my part, but that's kind of what I'm seeing.
So how far do you think we could see the stock market fall before we see Powell pivot again to try and save it from falling even more?
I mean, that's the $1 trillion question. Right? I think it's a really important question to try and answer. I think with the decline we've seen so far in the latest meeting, the Fed Powell said, made it pretty clear stocks haven't fallen enough yet to really get them to turn away from these, price stability side of the mandate, which is really what they're focusing on right now. We need to rein in inflation. But at some point, you're right, the stock market will, probably come down to a level that will make them become concerned about the economy. The Fed has used the stock market to try and pump up the stock market to try and create a wealth effect, get people to feel richer, spend more money. So they're also very well aware of the possibility of a reverse wealth effect. Stock prices go down, makes people kind of retrench in their spending. And so I do think, while some people have said the Fed put is gone, has expired, I don't necessarily believe that, because the stock market will come down far enough to where it will start threatening the economy. And that's the point at which the Fed will probably pivot again. I mean, whether that's down 20% or down 30%, I don't know. It's probably somewhere in that range.
Mm-hmm. And I've heard you say before that the Fed seems to be far more concerned about the negative wealth effect rather than the positive wealth effect. Is that right?
Sure. I mean, it's ridiculous, actually, how little the wealth effect accomplishes, right? I mean, because, it's the top 1% wealthiest people in the country that really benefit when the stock market goes up. And do they spend a ton more when when the stock market goes up? No, I think I saw a thing in the Wall Street Journal, today that for every, dollar of increased market value people have in their portfolios, they spend 3 cents. And so, the Fed has to really pump up markets to get any tiny little, wealth effect in the economy. But the reverse of that is potentially more powerful, right? I mean, I don't know if they've studied this, but if stock prices go down 50%, how much do people rein in their spending? It's probably more significant than the positive wealth effect. So there is a psychological factor that's really important, I think, and the Fed understands that in an asset price. I mean, this has been the impetus for all the Fed policy we've seen, right? Alan Greenspan was so afraid of the stock market crash in 2001 and 2. He was so afraid it was going to create another Great Depression that he lowered interest rates and consciously created the real estate bubble. Same thing after the financial crisis, as Bernanke was so worried that the loss of real estate values was going to create another economic Great Depression, that they decided to, do QE2, QE3, endless QE to try and prevent an economic catastrophe. So I think that's very clear that the Fed has said, or shown through their actions that they're, they're going to prevent that type of an economic calamity at all costs.
Mm-hmm. So a year ago, you wrote an article called "Dr. Copper Delivers a Diagnosis of Inflation." So can you explain to us what this relationship is and why copper is able to kind of foretell this inflationary environment that we have?
Yeah, I mean, honestly, I'm pretty amazed that I feel like I'm the only one, writing about this. But, it was a year ago, the Fed was telling us, don't worry, inflation's going to pick up, but it's transitory. People for a long time, Wall Street has referred to the copper price as Dr. Copper, under the idea that, copper has a PhD in economics. That copper's better. The signals coming out of copper price movements are better than any economic forecast you'll get from Wall Street or economists or whatnot. And so when copper, created a huge consolidation pattern over the past 10 years. Mm-hmm. And so, I just noted in that blog post, look, if copper breaks out to the upside, that is a clear sign that inflation is not transitory. And this comes back to Paul Tudor Jones. I mean, just basic technical analysis, that when a price breaks out of a big, consolidation range or whatever, it's a very clear signal that prices are going to continue to move higher in that direction. And that's exactly what we saw with copper. It broke out higher. To me, that was a clear sign that inflation is here and inflation isn't transitory. And so that's why I'm still watching the copper price, right? If copper's been in another consolidation range for the last 12 months or so, maybe not that long, maybe 8 or 10 months. But if it breaks out higher again, then that's a clear sign to me that the Fed still has not, done enough to address inflationary impulses in the economy. And so this is the dilemma the Fed faces, right? They want to do enough to tackle inflation. They don't want to do too much to crash the stock market. So Powell's walking a really fine line right now. And I don't think when you try and please everyone, you end up pleasing no one. And that's kind of, I think, the thing they need to worry about most is they maybe don't do enough to rein in inflation and still can't protect the stock market. Then they have a real problem on their hands.
Mm-hmm. So the chart you show in the article, while it isn't a perfect correlation between inflation and the copper price, it is quite close. So how far in advance does copper tend to show the path ahead for inflation?
Well, you tell me, Tom. I'm not looking at the chart, but I think it was something like 2 years. So copper prices breaking out, lead inflation by about 2 years. I think that's roughly right. There's also, there's a ton of other indicators that you look at for inflation. Small business pricing is another one that I look at, and small business has been saying for a long time that inflation is here. And inflation is not going away anytime soon. But so when you have the commodities markets, and then you have small businesses and all these things kind of saying, look, this is the biggest problem we have and it's not going away, then, it was inevitable the Fed was going to have to come out and say, okay, look, it's not transitory. We were wrong. We have to do things to address it. Now, the real problem for the Fed is that, inflation's running hotter than 7% today. Fed funds rate is 0. The last Powell pivot was, 2018, Fed funds rate was 2 and core inflation was 2, right? So you could argue they were, maybe behind the curve in raising rates through Janet Yellen and after Powell took over in the 2015, 16, 17 timeframe. They left rates too low, too long. But, as Stephen Roach recently wrote, the Fed is so far behind the curve right now, they can't even see the curve. So, it's just a very fascinating time. I don't think inflation is going away. And I don't think the Fed is as capable of even addressing it without causing real problems. And so the conclusion I come to is inflation is here to stay. Obviously we could see a peak in the year-over-year rate of change, but just because headline CPI comes down from 7 to maybe 6, 5, 4, doesn't mean that it's going to come back down below. Core CPI is going to come down back below 2. And so I think maybe that's where people are going to get a little confused, is they're going to say, oh, look, the inflation rate is peaking and rolling over. Well, yeah, that happens every time you get tough comparisons like we're going to start seeing in the spring. But that doesn't mean that inflation is done. You look at the great inflation of the 70s, and it was just a series of rising highs and lows. It was kind of a higher inflationary trend, and I think that's probably what we're in the midst of now.
Yeah, as you say, it's important to think about the comparison versus a year ago that we're seeing versus that longer term trend is. So
yeah, it'll be funny to see if people, if we see, last year CPI is up 4.5%, and this year's up 3.5%, and people go, oh, look, inflation's going away. No, look at that two-year rate of change is still massive, and it's not an accomplishment that it's gone down from 4.5 to 3.5. If it's still rising, dramatically above trend. And so that to me is what will be important, is look at the trend in CPI for the last 10 years. We're already well above trend. And so if we don't come back to trend, then we have a problem. And I don't think there's any way we're coming back to trend.
Mm-hmm. Yeah, I remember speaking to Danielle DiMartino Booth several months ago about the actual, that comparison, that rate of change when we were looking at in 2021 versus the numbers of 2020, when, everything was stagnant, everything was locked down. Nobody was really doing anything. Of course, it's going to look very dramatic at that point, but it's that longer term trend that really matters.
Yeah.
So, Jesse, when we think about inputs to rising inflation, is it possible that rising oil prices continue to be an important driver of continued upward trajectory of prices of nearly everything?
I do think the oil price is going to continue higher. That was another one where we've had a very long consolidation pattern over a decade, where oil prices have essentially been in a very long-term downtrend. We broke out of that downtrend last year, which is to me another very clear sign that this long-term downtrend in the oil price is over. Prices are now headed higher. Supplies are, the lowest in the last 5 years, and demand is going to hit a new record this year. So the fundamentals for oil price are very, very strong. And supplies, it's astounding to me too, to see that, people think we need to get rid of fossil fuels, right? Maybe that's probably a good thing for the environment, whether you believe in climate change or not. Just as an environmentalist, you'd say, okay, yeah, this is not healthy for people's lungs and all these things. But when you look at how many combustion engine cars are on the road today and how many are still sold every single day, we're not going to wean ourselves off of fossil fuels anytime soon, not even in the next 2-3 decades. Mm-hmm. It's something like less than 5% of all car sales in the US right now are fully electric, right? Even if we went to banning the sale of combustion engine cars, right? There's still going to be fossil fuel burning cars on the road for the next 10, 20 years. So the idea that we're going to wean ourselves off fossil fuels anytime soon is a fantasy. And so to put restraints and things on companies and their ability to produce fossil fuels is essentially ensuring that the price is going to be much, much higher over the next few years. And some people have argued maybe this is what we really need. Maybe you do need a $200 a barrel oil price to get people really fired up about alternative energy. And then that might be where we're headed. So I do think, energy prices are going to continue to power higher. That's going to power inflation higher. It's been astounding to me also to see the oil price so strong in the face of a strong dollar over the last, 3-4 months. To me, that just says, well, if the dollar was flat, oil price would probably be over $100 a barrel right now. And if the dollar reverses lower, as I think it probably will, you could see the oil price really take off. Mm-hmm.
So when we think about underinvestment in a sector like we have seen in oil over the past, let's say, almost decade, can we look at this as a good indicator of where we're likely to see appreciation of those stock prices as well?
Yeah, I mean, I've been super bullish on energy since late 2020 when I talked to Lee Gehring, who's one of the most foremost experts. People don't know his name, but they will. By the time this energy bull market is over, everyone will know who Lee Gehring is. Gehring and Rosenzweig, they do some of the best research in commodities investing that I've found. You saw, energy as a sector of the S&P 500, fell to less than 2% of the total value of the S&P 500. And in terms of revenues, energy is still, more than 10, 15% of the S&P 500 or something. So it was ridiculous how cheap these stocks became. They're still incredibly cheap. I think it's still less than 3% of the S&P 500 is the traditional energy sector. And so, this is, Paul Tudor Jones, again, said it on CNBC recently, the value of real assets, relative financial assets, is so incredibly cheap right now that to think that, this commodities bull market is over before it's even begun is just ridiculous. I think that all of these commodities are terrifically undervalued relative to the value of financial assets like stocks and bonds. The oil price, as I mentioned, is probably powering higher. If so, then a lot of these energy producers that trade at 4 times cash flow are just unbelievably undervalued, even still after, doubling and tripling in value over the last, year and a half or so.
Mm-hmm. So once the bubble is revealed for all to see that have somehow missed it, is it possible that we get a real sea change in investor preference away from growth stocks and back to these value assets, Jesse?
I think we're already seeing it. I mean, you look at what's energy's up 20% year to date. It was the best performing, sector in the stock market last year. Mm-hmm. And people still don't, haven't even noticed it yet. So I do think absolutely. And what is going to be the catalyst for this is a realization among investors that the Fed, its hands are tied. They can't do enough to really tackle inflation. The only way inflationary expectations and things are going to come down back to where they've been for the last 40 years is if you have a Fed like Paul Volcker that comes in and says, we're raising interest rates, we're going to normalize the balance sheet until inflation comes under wraps. No matter what happens to the economy, no matter what happens to the stock market, we're doing this. We're normalizing monetary policy, right? Clearly, Jay Powell is not willing to do that, right? And I thought it was very notable at the last Fed meeting that he declined to give any forward guidance whatsoever. If you were really determined to rein in inflation, you'd give all the forward guidance needed. You'd say, we're going to raise interest rates, we're going to normalize the balance sheet no matter what until inflation comes down. That's what Paul Volcker did. And he was willing to go through a couple of painful recessions in the early 80s in order to bring inflation back under control. Now, we maybe don't have near the inflation problem we had back then, but we have the biggest inflation problem since then right now. And we have a Fed that's not willing to make that kind of a commitment. And so I do think until you have that kind of a commitment, inflationary expectations are going to continue to grow and inflation will remain elevated. And so if you believe that inflation is probably going to remain elevated for an extended period of time, you think about what are the best ways to protect myself? Well, right now, the best ways to protect yourself are on sale in the markets. They are the cheapest areas of the market. And that's real assets and companies that produce those real assets, namely, energy, precious metals, these type of things. And so I do think that until you have a Fed that is willing to break the back of inflation, come hell or high water, you got to be, buying these types of securities in the markets that are, based on either the real assets themselves or commodity producers, energy producers, precious metals miners, these types of things. And I do think we are in the early days of seeing a rotation out of traditional financial assets, out of long duration, tech stocks and these kinds of things into real assets.
So, when we think about the stance of the Fed not being overly hawkish here, like you say, not giving any forward guidance, not committing to that normalization of policy, monetary policy. Do you think that the next time we see the Fed get even more dovish, that we see gold being a real beneficiary from that?
Yeah, I think you nailed that's the catalyst, right? So right now, the way I look at it is the dollar, the gold price are both pricing in 5 rate hikes and a reduction of the Fed's balance sheet. That's all priced in to the markets. So to the extent the Fed does not follow through on that market pricing, the markets will have to reprice. And so if we don't get 5 rate hikes this year, the dollar's overvalued. And if we get 2 rate hikes this year, 3 rate hikes this year, and then they pause, the dollar is going to roll over hard, and the gold price is going to scream higher. So I think the only way you can be bearish on gold today or bullish on the dollar is if you think markets still have more pricing in to do on the hawkish side of monetary policy. If you think we're going to get 6, 7, 8 rate hikes, if you think they're going to reduce the balance sheet by $1 trillion, $2 trillion, then I understand. Okay, yeah, then go buy dollars and sell gold. But if you think that the Fed is not going to be able to pull that off, that the Fed tries to reduce the balance sheet by $1 trillion, or pull that liquidity out of markets, and it's not going to be able to because the stock market's going to roll over or whatnot, and then trigger the Fed put, then yeah, I think you have to be very bullish on the gold price right now. Real interest rates. There's a very close relationship between the real 30-year Treasury yield, and I'm just talking about 30-year yield less core CPI. When that is deeply negative, it's very bullish for gold prices. It's deeply negative today. It's about as deeply negative as it's been in a long, long time. And based on that relationship, gold is terrifically undervalued. The only reason I think gold's not kind of fulfilling that role is because people are wary of a hawkish Fed. So the Fed's talking very, a good hawkish game right now. They've literally done nothing in terms of following through on that just yet. And to the extent that they're unable to follow through on what market has already priced in, I think is very bullish for the gold price. So we'll see. I mean, I think this year we will see that catalyst play out. I think we'll probably, get to the point maybe 3, 4, 5 months from now where the Fed is trying to implement hawkish policy and the stock market is trying to call their bluff. And the stock market is going to probe that level to find out where the Fed put is. Once the Fed put is triggered, the gold price just explodes higher.
Interesting. So do you think that there are more factors that go into propelling the gold price higher rather than just the dollar rolling over?
Yeah, I mean, I mentioned a little while ago about it's been impressive to see the oil price rise in the face of a rising dollar. But when you look at the dollar, also the strength in the dollar over the last 3-4 months has been impressive, and this has been related to monetary policy, I believe. But the gold price has been making higher lows all throughout the last 5 months, which to me is a sign of, very strong relative performance relative to the dollar. And so to me, that tells me that, if the gold were perfectly tethered to the dollar, it'd be making new lows right now and it's not doing that. So to me, that suggests that, the dollar has been a headwind for gold prices for the last 4 months, but I do think we're potentially close to the dollar rolling over. I mean, I think it's going to be hard for markets to start pricing in even more hawkish policy than they already have. To the extent that's true, the dollar could potentially roll over and become a tailwind to oil prices and gold prices.
So when we think about, let's say, the role of some of these oil equities and gold miners, do you think that they're going to be a really good hedge for inflation in this environment going forward?
Absolutely. I mean, I think, just for example, to me, I'm just astounded. I keep saying this, but I'm astounded at how cheap a lot of these gold mining stocks are. I mean, the one that just comes to mind is Agnico Eagle, because it's probably the highest quality gold mining company in the world, trades 4 times cash flow. Over the last 10 years, even through, 2014, 15, the depths of, the gold bear market, we saw the stock trade 10 to 15 times cash flow. So the fact that it trades 4 times today is just, to me, that's investors betting on a cyclical peak in the gold price. That, if the gold price doesn't break down dramatically, then this stock is significantly undervalued. I think the gold price needs to go down several $100s just to justify that price for Agnico Eagle. So, if the gold price just stays where it is, a stock like that could double easily. Now, if the gold price goes higher, I think it's probably going to break out to new highs this year. These stocks are incredibly undervalued. I mean, they'll have to trade. They're growing cash flow right now because the gold price is high. They're growing cash flow at a terrific rate, and they're trading as if they're, like cigar butts, Warren Buffett, old, companies that are going out of business in a few years' time. And so, I think, from a value standpoint, they're very attractive. But also just from an inflation standpoint, if gold's going to just kind of keep pace with the rate of growth in the money supply and whatnot, then the cash flow of these companies is going to grow significantly. And I think we're still early days in a bull market for these companies, and they haven't even. When you look at, to me, the growth of the gold price since 2015, 16, those lows that we saw, the miners haven't even reflected, that move in the gold price yet. And so if gold goes higher, we are going to see the next phase of the precious metals bull market is going to really be beneficial to the mining stocks. So I think that's probably the best way the miners are probably the best way to play a bull market in precious metals. And precious metals has historically been the best way to protect yourself from inflation. So I think it's really clear how to handle the current situation.
Mm-hmm. So while we've talked a lot about energy stocks and let's say gold stocks, is there anywhere else that you're focusing any of your energy as a real hedge for inflation or a way to make up some alpha in this environment?
I think in terms of alpha, there are a number. I think just the value. I don't like value as a system, right? I mean, mm-hmm. Some people will say, I want to just buy, value funds and these types of things. And probably value is seeing a new resurgence relative to growth. That's probably going to continue for some time. But for me, I think the idea of value as a system kind of undermines the idea of value investing that goes back to Ben Graham, right? The idea of value investing is analyzing individual companies and individual securities. And so to say I can just buy value as a group, doesn't work. I don't think Ben Graham would really endorse that type of a system. But I do think the idea of value investing in the Ben Graham sense of it is probably never been more attractive than it is today. It's something that I've been talking about for 3, 4, 5 years now, at least, that this move to passive investing, something Warren Buffett wrote about 30 years ago. He said, what greater advantage could there be in an intellectual contest than teaching the vast majority of investors, professional and retail, that thinking is a waste of time, right? That's what so many people have come to the idea, that thinking is a waste of time, just buy the index. And because so many people have embraced that idea, for those of us that are willing to go think and put that thinking to work in the markets, there are opportunities out there. I mean, Bed Bath & Beyond is a stock that I've kind of written about and talked about for a long time. It was $4 or $5 a share at the bottom of the pandemic. It went to 50. And it was trading at essentially below liquidation value at $4 or $5 a share. There's opportunities like that in stocks like that that are out there right now. And it's just, I think for a traditional old school value investor, this is a wonderful environment.
Mm-hmm. So, Jesse, a while back, you spoke with Michael Oliver, a great analyst that I've had the pleasure of speaking to many times. You wrote that he added a degree of technical clarity to how you analyze the gold chart. So can you share with us what he showed you and if you still find it useful?
Well, I'm glad you've talked to Michael. There's so few people that I find in the markets that have a truly unique way of looking at things. Michael's one of them. There's all types of ways of analyzing momentum. He does it in a way that I've never seen anyone else do, and I think just for that reason alone, it adds value. Now he has a long-term chart of the gold price, and I think it's the way he isolates momentum as a chart is he'll take the price relative to a moving average, and I think that the chart in question here is the gold price relative to its 36-month moving average. And when you plot that out, just that relative price movement, you can see, basically uptrends and downtrends. I think much clearer on those charts than you can see on basic price charts. And, he's also has a terrific chart of the NASDAQ and S&P 500 kind of on that same time frame where you see a huge, pattern of uptrend. And I think it's fascinating to see recently both the S&P 500 and the NASDAQ have broken down out of those 10-year-long patterns, which tells me that's a very important signal in momentum. Momentum has shifted for the first time in 10 plus years in those markets. We saw that in gold, in the last year or two also, where we had this bear market. It was a clear pattern, on the momentum chart, and it broke out higher, in the last couple of years. It's fallen back to basically test that breakout, which to me, it's kind of a pattern that I write about as a picture perfect bullish setup, right? Where you have the breakout above a range, come back to test that breakout, and that's usually like a wonderful entry on the buy side. And conversely, on the sell side, you see that long kind of pattern of uptrend. You see a breakdown. When you can rally back up to test that breakdown level, you potentially see a failed rally in that asset class. And so I think, it's fascinating to me that we're seeing this breakdown in momentum in stocks, probably the most popular, financial assets in the world, U.S. stock market. And we're seeing this breakout and test in the gold price at the same time. It potentially points to a very similar type of reversal that we saw in early 2000. I come back to this, where it was a great time to be a buyer of commodities and a great time to be a seller of stocks. That was the beginning of the lost decade in the stock market. Stocks went nowhere for 10 plus years, and commodities ripped higher for the following 10 years. I think this period right now, from not just the fundamentals, but the supply and demand and these types of things, and the sentiment, but also in these in the momentum and in the charts, are pointing to a very significant shift.
So it just sounds like it's another piece to add to the weight of evidence in gold's favor, right?
Absolutely. I mean, for me as a traditional value investor, right, the biggest kind of blind spot for a fundamental value investor is that value trap, that idea that I'm going to buy something that's cheap, but it's cheap for a very good reason, and because it's on its way to bankruptcy. So how do I protect myself from buying into those kind of things? How do I fix that blind spot? I need to add some kind of technical analysis or some kind of an overlay to understand when the market's telling me you're wrong, telling you, no, this is cheap for a good reason, it's going to continue powering lower. For me, momentum has been one of the ways to do that, is to look at when something has really strong downside momentum, it's not a good time to buy it. And vice versa, when something has really good strong upside momentum, don't try and short it. Look for those potential signs of momentum shifts. And I think we're at a really interesting juncture right now where we're seeing long-term momentum shifts in both real assets, namely gold, and in financial assets and stocks and bonds.
Excellent, Jesse. Well, I think that's a good place to kind of wrap up our conversation for today. Do you have anything else that you'd like to share with us before we do?
Just one thing I've been kind of suggesting to individual investors is it seems like most people don't have an idea of when to sell. There's all kinds of great ideas of why you might want to buy something, but most people, I think especially newbie investors, don't really have an idea of when to sell. And so just having some type of a sell discipline and saying, I'm willing to risk this much money or what have you. It could be some type of just a stop loss is very important. But think about when to sell. And if you don't have some type of process for that, use some type of a stop loss, because I think that's kind of, trading 101. And I think that could be very valuable to a lot of newbie investors in the current market.
So do you have any, kind of framework to how you think about, taking some of those gains off the table?
Well, yeah. I mean, as a fundamental investor, I'll come up with a thesis. And when I decide that thesis is wrong, it's time to get out. I mean, that's one of the things Jesse Livermore talked about. When you buy something and you decide you are wrong, there's only one thing to do, and that's stop being wrong by selling and getting out. And so I think that's something that's really important. But also, if you buy something for a thesis and it plays out and you were right, and you thought, this stock's going to go to $100, it goes to 100. That's a good time to sell too. When things, worked out. The biggest mistake I've made in my career is selling things too soon. That's something that, I need to work on, but I'd rather do that than hold things as they go to zero. And I think that's the big risk that we all need to avoid. And so having some type of a discipline, I think that the simplest thing I tell people is, when you buy something for a trade or for an investment, whatever, Paul Tudor Jones requires a 5-to-1 reward to risk ratio. So if I can make $5 on this, I think it's going to go up 5, I'm going to risk $1 on the downside. So if it goes down $1, that's when I sell and get out. And if you demand that on every trade you put on, you only need like a 25% hit rate to be profitable, 30% hit rate. You only need to be right that percentage of the time to be right, and or to make money. And so I think that's another good, just kind of simple rule of thumb for trading is, 5-to-1 reward to risk. It's a good way to limit, protect your downside.
Excellent. Those are some really interesting tips, Jesse. Of course, your website is the felderreport.com. You have some free material there on your blog, and you're pretty active on Twitter at Jesse Felder. Anywhere else you'd like to mention?
No, that's pretty much it. I try and put up a blog post once a week. I also put out a free Saturday morning email that goes out. It's pretty much just the 5 things during the week that I found of most value. So it could be an article, chart, whatever. So you can just sign up for that free email on my website on the homepage.
Excellent, Jesse. Thanks so much for your time and your perspective today.
Thanks, Tom. It was good talking with you. Appreciate it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.